I want to go over a home equity line of credit, or otherwise known as a HELOC, and how it can benefit you. So assuming your house is worth $500,000, right? And you have a $300,000 loan balance on this house. This is like a perfect scenario for easy math. We all like easy math, right? A lot of people are in this scenario. If you bought a house in the last couple of years, put 20% down, you're most likely in a spread like this. And what I mean is you have a $200,000 of potential equity or unrealized equity. And the only way to tap into that is do a full-blown cash out refinance, which rates are very high right now, or sell the house, or third, do a home equity line of credit, or second mortgage is also called. So I'm going to break it down for you real quick. A home equity line of credit, most banks, in fact all of them, will only loan up to 80% loan to value, 80% LTV. You may have heard of that before. 8 times 5 is 40. For simple math again, $400,000. That is the total amount that the home equity line of credit bank, the Federal Credit Union, will loan up to. But don't forget, you have a $300,000 mortgage in place. So there is a $100,000 spread between these two. And that is going to be your line of credit. That's going to be your new line of credit right here with your second mortgage. And the best thing about this is you don't make payments on that money unless you start using it. It's a lot different than your original 30-year fixed balance, loan balance mortgage that's in place. You only make payments on that when you start drawing from it. And what I mean by that is when you close on your second line of credit, you get a checkbook. And with that checkbook, you can deposit checks into your checking account. And then once you start doing that, you can write checks to people or you can deposit checks in your checking account. Then you start making payments on it. The payments are structured a little bit differently. This is a 30-year loan. This is a 25, which means if you make the minimum payments on your $100,000, assuming you pull all $100,000 out right away, you'll pay it off in 25 years. Your original, most likely 30-year fix, you make the payment every month, you're going to pay the mortgage off in 30 years. Line of credits are a lot easier to get. They're cheaper. There's only a drive-by appraisal fee of a couple $100, I think I did on my last one. And you send them a spec sheet about the house and they dig into the comps and stuff like that. But there's no title insurance. There's zero closing and costs. And the interest rates associated with those are prime, prime -1. They vary whether it's your primary residence or it's an investment property. I have home equity line of credits on a couple of my investment properties as well, and the rates are a little bit higher. We'll get into that in a different video. But this is a great tool to use whether you're looking to invest. You can buy a house in cash. I don't know if you can do that for $100,000 anymore, or you could use this money to put your kid through school, or what I like to do is I use this $100,000 and I write checks to contractors. I don't want to touch my original loan balance, and if I'm working on renovating a flip or a rental property, instead of taking hard money loan or a construction loan, which interest rates are really high, I'll use my home equity line of credit, write checks to plumbers and carpenters, and I'll renovate a flip and then sell it. And then once I sell the house, I'll pay off the $100,000. I don't pay it off, I just pay it down. And I can draw from it whenever I want. So this is a great tool. I highly recommend it. And I hope this simple math simplified things for you. If you have any questions, please don't hesitate to drop a comment below. Thanks.